Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. If you like our content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. In this video, we'll be talking about 5 fundamentally sound stocks which have corrected severely and which can be cherry-picked in the current market. Now friends, this is not our own research and this article was published in Outlook Business. We'll be providing the link to the article in the description section. Please watch this video to know more about these stocks. Now the first stock on the list is Indraprastha Gas Limited, which is available at rupees 310.30 and the face value for it is 2. The symbol for it is IGL. Now if you were to look at this company, Indraprastha Gas Limited is an India-based city gas distribution company. The company's business consists of sale of natural gas. The company is focused on industrial and commercial businesses. The company supplies compressed natural gas, which is CNG, to the transport sector and piped natural gas, which is PNG, to the domestic, industrial and commercial sectors in Delhi and the National Capital Region. Now, India's shift towards natural gas, which is environment friendly, has driven sales volumes, and analysts believe that the volume growth momentum will continue as the government focuses on green initiatives. The switch over to CNG continues to grow owing to regulatory push and cost benefits of using natural gas. IGL's latest decision to increase prices by 3% on May 29, soon after raising them by 0.9% a month or so earlier than that decision, reflects the company's ability to ride on the impact of higher crude oil prices to some degree. Besides, the company is also in growth mode. IGL is expanding its pipeline to new areas like Karnal, Rewari and part of Gurugram, which will add PNG volume. CNG volume will also continue to be robust owing to conversion of Ola, Uber and private cars. Monopolistic business model and robust growth from investments in subsidiaries coupled with a foray into newer geographies means that this stock will do very well going forward. IGL offers investors a rare mix of volume growth and healthy margins, which is a sweet combination. Now, if you were to look at the 1-year chart, you would see that the stock had corrected substantially from its mid-year high, but of late it has again resumed its uptrend. The market cap of the stock is 21,721.02 crores, which means that the company is a large cap one. The EPS of 9.58 translates into a price to earnings ratio of 32.39, which is much cheaper when compared with the industry PE of 37.58. The book value of 51.39, however, translates into a price to book ratio of 6.04, which is a bit expensive. The company has a debt to equity of 0.1922, whereas the return on equity is a decent number and stands at 0.1914. The dividend yield is 0.55, whereas the promoter holding is just below average at 45%. The second stock on the list is EIH Limited, which is available at rupees 162.75 and the face value for it is 2. The symbol for it is EIHOTEL. Now, EIH Limited is engaged in hospitality and related services. The company operates luxury hotels under the brand name Oberoi and 5-star hotels under the brand name Trident. The company operates Oberoi hotels in India, Indonesia, Dubai, Mauritius, Egypt and Saudi Arabia, among others. Now, East India Hotels has also been a victim of the mid-cap sell-off despite reporting robust growth. The hotel industry has been witnessing growth mainly led by healthy increase in the number of foreign tourists, limited new room additions and an uptick in domestic demand. Given that the major chunk of room supply will only come post 2022, EIH is well placed to take benefit of low supply and high demand. EIH witnessed an upward trend in revenue and profit led mainly by reopening its main property in Delhi. Analysts are backing the company, which run luxury hotel chains like Oberoi and Trident, to lead the industry owing to the impending launch of 6 new hotels with 893 rooms that are in various stages of construction and are expected to be operational in the next 3 years. The revenue is expected to grow at a CAGR of 15% over the next 3 years. The properties of EIH are strategically located in business as well as leisure hubs, and the rise in occupancy levels supported by healthy demand would lead to rise in room rates going forward, thus leading to robust margin expansion. The uptick in demand will also improve the company ROIC, which is expected to reach double digits in FY19 from 6.2% in FY18. expansion at a time when government's thrust is on tourism puts the company in pole position to exploit rising demand. Its fixed assets valued at Rs 23.78 billion also provide a good cushion to investors. Looking at the 1-year chart, you would see that this stock had a huge spike towards the middle of the year, but since then has been on a consistent decline. The market cap of the company is 9,302.29 crores, which means that the company is a mid-cap one. The EPS of 1.94 translates into a price to earnings ratio of 83.89, which is much more higher compared with the industry PE of 65.58. The book value of 49.27, however, translates into a reasonable price to book ratio of 3.30. The dividend yield is 0.55%, whereas the promoter holding here is lower than average at 35.25%. Now the third stock on the list is TVS Motor Company Limited, which is available at Rs 520.35 and the face value for it is 1. The symbol for it is TVS MOTOR. Now TVS Motor Company Limited is engaged in the manufacturing of motorcycles, scooters, mopeds, three-wheelers and parts and accessories. It has approximately 4 manufacturing plants, 3 located in India and 1 in Indonesia. Now if you were to look at the 1-year chart, you would see that this stock rose for the first few months of the year, but since then has been on a steep decline. High input cost, increased dealer margins and one-time promotional expenses hit the margins and spooked investors over the last few quarters. Analysts believe that the rising cost of raw materials should not perturb investors anymore, as the company has implemented 2 consecutive price hikes in April and May to pass on the inflation cost and dealers' incentives to customers. When there is strong demand in the market, it has a decent pricing power. The depreciating cost of rupee is also expected to support margins as the company outperformed the industry in exports. Rich product mix and strong brands are expected to help TVS Motor to ride the rural consumption growth story. Now, if you were to look at the market capitalization, the company is a large cap with a market capitalization of 24,721.16 crores. The EPS of 13.95 translates into a price to earnings ratio of 37.30, which is much more expensive when compared with the industry PE of 20.09. The book value of 60.63 also translates into a price to book ratio, which is on the higher side, and that stands at 8.58%. The dividend yield is 0.63%, whereas the promoter holding is better than average at 57.40%. Now the fourth stock on the list is Natco Pharma Limited, which is available at Rs 801.35 and the face value for it is 2. The symbol for it is NATCOPHARM. Now Natco Pharma Limited is a pharmaceutical company engaged in developing, manufacturing and marketing finished dosage formulations and active pharmaceutical ingredients. The company's segments include active pharmaceutical ingredients, finished dosage formulations, job works, pharmacy and others. Now, while its peers are grappling with pricing pressure in the US and lackluster growth in the domestic market, Natco reported very decent net sales growth over the last few quarters. The drug maker even rewarded its employees with a one-time special bonus in June for the second year in a row. While the windfall from the US market is set to continue, the company plans to focus on 3 specific markets, which are India, Brazil and Canada. The management's decision to also focus on markets apart from the US comes on back of rise in revenue from Brazilian and Canadian markets. These 2 markets contributed $4.5 to 5 million and Canadian dollars 15 million in FY18. Now Natco Pharma is also a leading player in oncology segment with 30 products. The segment has grown at 19% CAGR in the last 5 years, contributing significantly to revenue. Even in India, Natco has been operating in very niche market and has largely focused on oncology segment through diverse range of drugs, which has worked well for them. Analysts believe that the momentum in oncology segment will continue on the back of incremental launches. Now, if you were to look at the market cap, the company is a mid-cap with a market capitalization of 14,784.38 crores. The EPS of 37.84 translates into a price to earnings ratio of 21.18, which is much cheaper when compared with the industry PE of 30.12. The book value of 130.08, however, translates into an expensive price to book ratio of 6.16. The debt to equity here is 0.0897, whereas the return on equity is a very strong number at 0.2949. The company has a dividend yield of 0.84%, whereas the promoter holding is just about average at 48.38%. The final stock on the list is Mahindra CIE Automotive Limited, which is available at Rs 253.35 and the face value for it is 10. The symbol for it is MAHINDCIE. Mahindra CIE Automotive Limited is an auto component supplier with presence in many technologies which include forgings, castings, stampings, magnetic products and composites. The company is focused on the automotive segment including cars, utility vehicles, commercial vehicles and tractors. Like Natco Pharma, Mahindra CIE Automotive's drop in stock price has also made it an attractive bet. CIE has implemented several initiatives of cost rationalization which have started yielding positive results. After the fall earlier this year, investors are lapping up the stock post strong numbers. Analysts believe that there is more upside to the company. Now, if you were to look at the one-year chart, you would see that the stock has largely been choppy and no major wealth has been created here. The market cap of the company is 9590.51 crores, which means that the company is a mid-cap one. The EPS of 3.10 translates into a very expensive price to earnings ratio of 81.73, which is much more higher compared to the industry PE of 44.93. The book value of 92.45, however, translates into a reasonable price to book ratio of 2.74. Now, the company did not pay out any dividends and the promoter holding stands at a strong number of 69.83. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.